Market slips to the day's low. Midcaps drag, IT and realty lead the decline, while healthcare and auto buck the trend.
The Central Electricity Regulatory Commission approves market coupling for power exchanges in the day ahead market segment Jan 1st, 2026, delivering a body blow to IEX. The move is expected to see business migrating to other exchanges. The stock tanks.
IT stocks fall despite a standout performance from Infosys, even Coforge and persistent fall due to steep valuations and some concerns on margins for the former and the deal wins for the later.
Dr. Reddy's climbs after a sell-off in earlier sessions as sales comes in mostly in line and margins beat estimates. The company also guides for a healthy growth and margin going forward.
Nestle India's profit dips on higher depreciation and finance costs even as sales come in mostly in line. Margins dip on high commodity prices, but price stabilization and a pickup in urban growth improved the outlook.
Hello, welcome and good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra as always. Good afternoon, guys, but not a great afternoon shaping up for the markets, right? We're seeing the Nifty almost near the day's lowest point. 25,000 is what it's managing to hold on to, but a lot of earning movers also coming in today, right? We're seeing Nestle that came out with its numbers, so there's some bit of that impact coming in the stock as well right now. And Nestle is among the top losers, then Trent on the back of brokerages, so we're keeping an eye on that. The broader end of the market is also not doing anything exciting.
Hi guys, yes, absolutely. Definitely disappointing, especially when there's so much enthusiasm with the trade deal in many other geographies. Maybe there is some amount of, trepidation for the Indian markets at this point in time. The mid-caps are underperforming this afternoon. So we have the broader markets which are under pressure at this point in time. So maybe your little portfolios are going to feel the pain in today's trading session. A lot of stocks in focus. So that continues to be the larger theme, stock-specific action playing out. So we spoke about IEX, persistent systems in terms of a result reaction. Nestle just some time ago. Thyrocare, Seneris Pharma, and not to mention even Indico Remedies, which is on your screen. Margins have dipped very significantly and it's a net loss this quarter as well.
It'll be very interesting to see where the market goes from here on, Ekta. Why do I say that? Because, 25,000 is an important support for the frontline index. We have the weekly options expiry that plays out. And amidst all of this, the street was hoping for some improvement in the IT sector coming in, largely on account of Infosys numbers. But that hasn't taken place. And add to that, I'll be very interested in watching out what Nestle does as well. Because, the results were obviously understandably weak. But two things are playing out for Nestle going forward. From the management commentary, the demand is likely to improve from here on. And secondly, the costs are likely to reduce from here on. So both these factors are positive. And add to that, you have a new leader coming in as well. Manish Tiwari takes on as the CMD and, the CEO of Nestle from August 1st. So typically for FMCG companies, a leadership change denotes a strategy change as well. So do we see, improved performance or increased growth numbers from Nestle going forward or not is something I'll be watching out for because, the stock was already 12% off its 52-week high ahead of numbers. So we'll talk about that. And the casualty of the day has to be IEX. Opened 10% lower, that temporary freeze, thereafter went to 15% lower, and thereafter 20% lower. And guess what? It's down 26% right now as we speak. 47% of its volumes coming in from day ahead market, the volumes, the trades out there. So from becoming an exchange, now essentially the company is limited to becoming a broker for power trades, and as a result of which that big decline. The other factor that comes in is that the stock is an F&O ban. So no fresh positions can be taken to be carried to the next trading session. So that also is further exacerbating the moves that we're seeing on IEX.
Absolutely. So that definitely is the big stock of the day, but you can't ignore a lot of result reactions which have been on the positive side. We in fact spoke to the management of Seneris earlier, where that stock is up around 13% reacting to its numbers. But the other one is Thyrocare, which is doing well. So the diagnostic company is buzzing trade and should come up for you. It's up around 10% at this point in time, reporting what was a strong set of numbers this time. The profit zoomed significantly year on year, and the company witnessed around a 12% growth in patients. We have Rahul Guha, who's the MD and CEO at Thyrocare, joining in to discuss the numbers gone by. Rahul, hi. Thank you very much for taking the time out. This is Ekta. Just wanted to start by discussing the pathology revenue, which is up 25% year on year. Just tell us what took place this quarter in terms of volume as well as prices, and what is your guidance going forward in terms of the sort of competitive environment that diagnostic companies have been dealing with?
Hi, good afternoon. And actually, what you're seeing is, relentless execution, I would say, over the last 8 quarters. As I've been talking about, this is a very simple business. You need to add more franchisees, add more partners, keep them happy, and the growth will come. And if you look at our track record over the last 2 years, we've been consistently adding franchisees. This year versus the same time last year, we added about 1,500 franchisees. And that's what's resulting in the growth. So there's a compounding effect, that I would say we really started on this journey about 2 years ago. And you're now starting to see the compounding effect of that buildup of franchisee addition over the last couple of years. Nothing new, I think, from this quarter. It's just, the continuous trajectory and the compounding effect that you're seeing.
Okay. Well, the compounding effect is one. Just wanted to understand the pricing scenario now. Were there any price hikes taken? If so, when was the last price hike taken by the company? And what is the possibility of price hikes going forward?
See, while, if you break down the 25%, you would say, about 15% is test volume and 11% is what, is realization. But actually, our stated position is to be the most affordable player in diagnostics. So we don't take price up that much. Actually, that 11% that you're seeing in realization is mostly from mix. Over the last year, we've added a number of specialized technologies that effectively increase our realization per test. And what you're seeing there in that 11%, I would say almost 9% of that would be mostly mix. And maybe about 1-2% would be actual real price hikes.
That exactly
our mission is to make testing affordable. And so we very rarely resort to price as a lever.
Yeah, that exactly is what we wanted to know in terms of a lever going forward as well. What proportion of your growth do you attribute going forward to volumes? And you said that, 9% of the near 11-12% realization growth has been on account of mix. So what is your revenue right now that comes in from the better realization products, and how much do you intend to take that to as a proportion of your overall tests?
So I'll give you broad numbers because the exact numbers, are internal to the company and actually part of our strategy. But if you say routine and semi-specialized is roughly about half our mix, and the more higher realization is the other half. If you go back maybe 2 years ago, it would have been 1/3, 2/3, 1/3. So that's the level of mix that has moved between, let's say, the run-of-the-mill thyroids and HbA1c and lipid profile versus the more specialized coagulation, histopathology, and more advanced testing.
And what is the delta between the higher-priced half and the routine half? How much higher is the higher versus routine?
On average, the realization would be 3x. Between the routine and the semi-specialized and more specialized.
Right, Mr. Guha, good afternoon. What we also want to know is in terms of overall, what is the revenue that you're generating from preventive testing, Janch, which is the screen testing side as well, and Her-Check. What is the growth this time that you've seen in this quarter? What is the guidance that you have in terms for FY26?
So we are very famously known for preventive testing with Aarogyam. Aarogyam continues to be roughly about 40% of our revenue. So we are the largest preventive testing player in the country overall. Janch, as I said, is a new launch. So it's probably accounts for about 5-10% of our 5% of our overall revenue, but growing very, very fast.
Okay. And what would be that outlook of growth? What rate could we expect Janch to grow? Now, given that it's newer as well, what is the growth rate that you are anticipating and an internal target that you're watching out for?
We expect Jans to grow between 1.5 to 2x our normal growth rate. So that's typically what we expect Jans to grow faster.
Okay, so you're expecting a growth of around 1.5 to 2x for Janch. How much did Arogyam grow this quarter and how much did Hercheck grow this quarter?
Hercheck is a very, very specialized test, so I'll keep it out of the purview. Arogyam would grow in line with the company.
Okay, all right. Tell us what's happening, Rahul, with Africa. You all have ventured into Tanzania. Tell us about the expansion plan that you have. How much have you generated in terms of revenue there? And how important a piece is Africa going to be for Thyrocare?
It really depends on if you're with us for, a 5-10 year horizon or if you're with us for a 2-year horizon. If I look in the long term, Africa will be a very big pillar for Thyrocare. But in the short term, we are still understanding the market, getting our business model right, ensuring we fully understand the go-to-market. So I would say, in the next 1 to 2 years, both from an investment bandwidth as well as, revenue and profit, Tanzania will not be material. But if you take a 10-year view, I believe, Africa will be a material part of the growth of Thyrocare. But as I said, we are still learning the Africa market. It's only been little less than a year that we've been in Africa. So I think it's too early to, start to bake it into any projection.
Just as a whole for Thyrocare then, you've done around 23% of growth. You've got back to your margins of around 30-odd%. This is a two-part question. Thyrocare at one point in time used to enjoy margins of as much as 40%. What's the internal target when it comes to margins? 1. And 2, in terms of this 20% growth, are we going to see this as a standardized normal growth rate for the next couple of quarters?
Difficult to say at this point. See, normally Q1 is very soft. Very rarely does Q1 exceed Q4. But for us, actually, Q1 has been much better than Q4 as well. So we are very encouraged by the growth numbers that we are seeing. Q2 always tends to be better, but you must go back last year. And if you see the compounding effect I talked about, you started to see it, I would say, around Q2 of last year. So we are sitting on a very high base, as we move into the back half of the year. So it's too early for me to revise guidance at this point. I think, in the mid-teens to, closer to 20% is in the range. I think it's very difficult to say, whether we'll close the year beyond that. But I've always been saying that mid-teens is where we are, we would be happy. We've done very well in the first quarter and very encouraged by the growth numbers that we've seen. But let's see how the back half comes. Maybe the next time we meet after H1 behind us, I will.
And what about the margins, Rahul? Those, historic highs that Thyrocare used to see.
See, the margins is a result of operating leverage, right? If we continue to grow at this rate, margins will definitely improve. But as I said, we are not a company that stands still. We continue to invest. We're looking for more M&A. We're looking to expand our footprints in different parts of India that we're small. So I would say, whatever operating leverage we get, the first priority will be to see where we can invest it for growth, right? So assume, the margins will be stable at this point, at this level, and we'll continue to invest to drive growth further from where it is today.
Rahul, from a stock market standpoint, the street was always curious about the future of both PharmEasy and Thyrocare. At any point in time, you are looking at expansion, you are looking at growth, etc. Is there a consideration of both of them coming together and PharmEasy listing via reverse merger with Thyrocare?
I think this has been asked multiple times. I've been candid,
which is what keeps coming to us from all the people who've invested.
Yeah. See, this is not a subject of any discussion at Thyrocare level. If at all it comes up, as I always say, Thyrocare shareholders, this will be a special resolution which will require a majority of the minority. So it's not that straightforward, that it can be a done deal. But that being said, there has been no discussion on this front, at least at Thyrocare level at all.
Okay, Rahul, thank you so much for giving us those updates over there. Not on a discussion point as of now for Thyrocare, but thanks for joining in with us, giving us those updates in terms of what we should be watching out for the company in FY26, looking at mid-teens growth for the full year. So let's keep an eye on that. But on that note, we're going to sip into a very short break, but a small programming note for our viewers as we sip into this break. As the workplace transforms, so most leaderships. In the Bangalore edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC TV18, CNBC-TV18.com and YouTube.
Welcome back. Well, under pressure for the markets, so the Nifty is down around 159 odd points, just about holding that 25,000 level. What's concerning is the advanced decline ratio and the gap that is there between the advanced decline ratio that should come up for you. So around just about 1,600 stocks advancing to around 2,400 stocks declining. So as you can see, the gap is only widened as the day has gone on. But let's focus on an important story and what might be the key focus for today. Prime Minister Narendra Modi has arrived in UK ahead of signing for the free trade agreement with the United Kingdom. That will take place later today. Parikshit is here. He's been tracking the story. He's here with more details on this. Parikshit, over to you.
Well, the big headline is that India will be reducing the average tariffs for UK products from 15% to 3% under the FTA. So UK products such as UK cars, Scotch whisky, cosmetics, gin, soft drinks, lamb and medical devices will get cheaper in India. UK's clean energy industry will also have unprecedented access to India's vast procurement market. And this is according to a statement by the UK Prime Minister's office. The UK insurance industry will be able to expand in India because there will be a binding investment cap in the FTA. And also, there will be locked-in access for UK financial services companies. So they will benefit from certainty, transparency, and they'll be able to expand in the India market. On the India side, let me begin with marine exports. FTA will eliminate tariffs on 99% of marine exports from India, including shrimp, tuna, fish meal, and feeds. Tariffs on Indian leather and footwear will be eliminated from 16% to zero. Duties on Indian textiles to be reduced from 12% to zero. India's leather exports to UK will get preferential access over Bangladesh, Pakistan and Cambodia. Tariffs on engineering goods will be reduced from 18% to zero. Generics, they are going to benefit from zero duty access in the India market. So the Indian pharmaceutical industry, the generics market will benefit significantly, and so will gems and jewelry sectors, toys, plastics, chemicals, all of them will benefit from reduced tariff concessions and reduced barriers of entry in the United Kingdom. We will also see zero duties on 95% of agricultural and processed foods. So your exports of fruits, vegetables, cereals, pickle, spices, processed foods, ready-to-eat foods, all of that will get cheaper. But India's red lines on agriculture have been protected. So there'll be no concessions when it comes to dairy, apples, oats, edible oils in the India market, and neither wheat, rice and maize.
Okay, Parikshit, thank you so much for that important updates that we'll watch out for in terms of the India-UK FTA that will come in. But let's move on and talk about the auto sector, because we're seeing some of these names that are gaining in trade. And this is why after US has announced a trade deal with Japan and is inching forward to signing an agreement with the European Union as well. Now, how does this play out for our Indian players? We have Sudarshan joining in with us to give us details on this front. Afternoon, Sudarshan.
Good afternoon, Vinny. So some of the auto stocks and auto ancillary names are in focus because certain reports suggest that US and EU are getting closer to signing the trade agreement. And as per the trade agreement, EU exports to US tariff for that will get reduced to 15%. And as per the reports, trade agreement will also include auto cars and auto parts. Now, if that is included, it would be positive for companies like Tata Motors, Samvardhana Motherson, Sona BLW and Bharat Ford. So why it would be positive for Tata Motors? So already US and UK have already signed the agreement, and as per that agreement, tariff rate for UK exports has reduced to 10%. Now, Tata Motors has an important plant in Slovakia from where higher end of Land Rover is exported. Now, if there is an agreement within US and EU, for that also tariff will be reduced to 15%, and that would be hugely positive for Tata Motors. And remember that for Tata Motors, 33% of JLR volumes come from the US market. Now coming to Samvardhana Motherson. So it supplies to OEM plants in countries like Mexico and Germany, and that exports to the US. So indirectly, it would benefit Samvardhana Motherson also if there is an agreement. For Sona BLW, US contributions are around 43% to its total revenue. Now US President has been announcing trade agreement with so many countries, and now going forward, if we see much more trade deals, then it would be taken positively. And for Bharat Ford also, US exports form nearly 35 to 40% of its total revenue. So in the next few days, if we get to hear an agreement between US and EU, and under which trade tariff is really reduced to 15%, this would be positive for these companies.
Okay. All right. Thanks very much for that, Sudarshan. Well, just watch out for Zydus. They have received an approval, so that company, that stock should come up for you. It's up around 1%. Well, we need to take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back. The Nifty just below that 25,100 mark right now is a significant downtick that we've seen as against an expectation of an up move that we would see. A bunch of stocks not doing particularly well as well. As we move towards the expiry, let's go across to Nigel, who's picking up all the trends from the F&O desk. Nigel.
Well, that's right, Mangala. You know, if you look at it, we have seen that both the Nifty and the Nifty Bank, they're under pressure, but it's not such a big worry. The reason I say that is because there's no big open interest build up out there, and this market as it is net short. So just take a look at the open interest, not too much build up out there. Moving to the Q that you'll track very closely is the Nifty PCR. You know, it started off today, it was at around 1.15. And in the last few sessions, it's moved from around 0.75 all the way around to around 1.15. In fact, in the initial part of trade, it went to around 1.2. Now that's cooled off to around 0.7. Normally at around 0.65, 0.7 or thereabouts is when you see a bounce. Keep in mind, today is a weekly expiry, so things will get volatile from here on. But that's a Q normally you clutch onto. The FIs remain in net short, and you have the PCR that comes down to around 0.7. The combination of the two normally indicates a bit of a bounce in the near term. So that's the important mark to track. Now the call writers, they are feeling very, very good. How does the PCR come down? When in fact there is aggressive call writing. And take a look at the open interest build-up that we have seen. The premium on the 25,200 call, 25,150 call, 25,100 call, all three of these strikes, the premium is down by around 90 to around 95%. So the call writers, they are writing these strikes very, very aggressively. And if you just add the premiums at the start of today to all of these strikes, what it points to is around 25,250 mark. That is the important mark on the upside. So all the three strikes, if you just take a look at the premium, if at around the 25,100, the premium at the start of the day was more than 100, 120 rupees or thereabouts. So there's a sharp decline that we're seeing. Going by the options data, going by the technical factors that you're looking at, well, a few numbers that you should be looking at. The 20 DMA, that's important now for the Nifty on the upside. But in the near term, going by the options data, 25,250, resistance mark out there. On the downside, going by the put writing, the 25,000 mark becomes very, very important. The Nifty Bank, well, that in fact is underperforming today, which is a bit of an issue. But for the Nifty, the 20 and the 50 DMA become the important resistance mark in the near term. So you'll have to keep an eye out on both those two. Stocks that I'm looking at, ITC, big unwinding of long positions is what we're seeing out there. So that's why that stock is lower in trade. And Coforge, the open interest build-up is massive, more than 10%. So big shorting on that one as well. Back to you guys.
Okay, all right, Nigel. Well, that's on the F&O update from our F&O desk coming to you live. But we now have Aditya Agarwal, Head of Research and Investments at Invest4Edu, joining in on the show to tell us what he's tracking today. Aditya, hi, welcome to the show. Well, it's definitely a dull day, but what's your call on the index?
Hi, good afternoon, Ekta. Thanks for having the show. My sense, it's more of a movement that we're witnessing because of the expiry today. It's more of a Thursday expiry move, weekly expiry that we're witnessing. Clearly on the downside, as Nigel was also suggesting, options data do suggest that 25,000 is a key support. And immediately, I think 25,050 is also an immediate support if you take a look at the way put writing has been taking place at both the strike prices, 25,050 and 25,000. My sense is markets will try to hold on to these support levels of 25,050 and 25,000. So for the day, 25,000 remains a very important support zone. Things might change very quickly, Ekta, if we start to trade about 25,100 mark again, because that is where we are witnessing suddenly an unwinding of open positions and then a buildup of writing as well on the call side. So if we start to trade above 25,100 throughout during the course of the day, my sense is you could witness a short covering rally again, and you might just scale back to levels of 25,150, 25,200. So I won't read too much into this correction that we're witnessing in trade today. More of an expiry day kind of a move.
All right, Aditya, we request you to hold on to your thoughts. We'll come back to you. There's breaking news. So we have Manoj Kumar Jawar, who's the Chairman and Managing Director at PTC India, joining us on the phone line. This is on the important news that has IEX lower. The CERC speaking about market coupling in a phased manner. Thanks a lot, Mr. Jawar, for joining in. Your initial reaction on this, your belief around, why do you think this makes sense according to you? And what's your rationale? And what would your steps from here on be for here?
Number one, it is a very good development because you see in the collective segment, there was practically no competition. Now all the three exchanges would have an equal shot and equal opportunity to serve the customers. So whoever is able to serve the customers better would be able to grab the market share. Currently, all the volumes were concentrated in the incumbent exchange, which was IEX. Last year, I think around 61 billion units were traded in the DAM segment in the IEX. Now, if a fair share is captured by other exchanges, so I believe it will be good for the market, good for the constituents, and good for the people whom the exchange is serving.
Mr. Jawar, thank you so much for joining us. Vivek joining in from the research desk as well. Sir, a couple of questions. Sir, currently, what is the total quantum of your ownership in HPX? We believe that you're one of the majority holders there. Number two, what is the current market share, especially in the day-ahead market, where there is going to be immediate implementation as early as January 2026? What is the current market share that you enjoy over there? And by the end of the year, what will be the market share that you will be able to take, given the fact that right now IEX enjoys dominant position?
Yeah, so number one, we own around 22% in the IEX. We collectively own a majority holding in the IEX along with the Bombay Stock Exchange and the ICICI Bank. So our holding is around 22%. That is number one. Number two, currently practically all the volume in the collective segment, which is the DAM and RTM put together, is being served by IEX. Almost more than 99%. There are good reasons for that if a new buyer or new seller is coming to the market, he would like to go where the liquidity is. Since there was no market coupling, no one was able to place any bid on any other exchange, even if he wanted to. So we believe that given the chance of coupling, now exchanges would have to compete on services. And on that, I think we being a very, very new and advanced technology platform, we will be able to get a good market share.
Okay. Mr. Jawar, I believe you said you have ownership in HPX, right? That is the quick correction that I wanted to confirm with you.
Yeah, HPX,
right.
HPX, that is what I said.
Yeah. So the other question that we have is, the current transaction charges at IEX are close to 4 paise per unit. In fact, it is amongst the highest as far as, global power exchanges are concerned. What are the transaction charges you are actually, going ahead and charging your customers? And do you see scope to bring it down further? We believe that will actually help shift away volumes from IEX and, going forward, do you feel that there can be a 33% market share each across all of the three exchanges?
Yeah, I believe the exchange which is able to provide services would be able to win the market share. That is number one. And definitely the service charges would be one variable in this equation. We will see what kind of benefits we can pass on to the customers, whether that can be loyalty based, whether that can be transaction based, whether that can be volume based. That has to be seen. A strategy would have to be evolved. But definitely this competition would be good for the customers, good for the market.
Good for customers in the market, Mr. Jawahar, but what we want to understand is, in the current infrastructure that there is, do you think competition would be able to provide the service that IEX is doing? And because IEX will be worried about, their market share going to the others, they would not focus as much on the service as well. So do you think incentivizing one player would have been good for service as against giving it to everyone, and as a result of which maybe customers not benefiting despite the intentions being the same?
You see, monopoly has never been good. It can never be good for the services, can never be good for the customers. If a monopoly, even if not dictated by law, but because of the reality of the situation, if all the volume is concentrated in one exchange, then you can understand that is the human behavior. So I believe competition is good, and since this market coupling provides a fair chance to compete on services, so I think customers will be benefited. There is no doubt about it.
Mr. Jawahar, the other important question, just taking a cue from what Mangalam asked you. Number one, do you have the necessary technology in place to actually go ahead and allow for the price discovery process? Currently, majority of the volumes are at IEX, so we believe it's happening over there. So by Jan 2026, will that be on board for you? Or in case you don't, would you be taking the price discovery process, or would that shift to Grid India?
No. Absolutely, we are absolutely capable of. HPX is absolutely capable of discovering a price in a collected market, and this market, a coupled market also. So I see absolutely no challenge on that. Our platform in the HPX is quite capable of handling anything which is required of it to be done.
So, from the point of view of PTC India, where do you believe, the revenues of this particular exchange will scale up to as part of your overall consolidated financials? And typically, we understand margins over here are quite high. So, consolidated basis at the end of FY27, if you could quantify it for us, what kind of contribution you could see?
You see, we have to see examine that question from two angles. Number one, what were the current margins and the current revenue in the collective segment in the exchanges? So if I say that DAM volumes were around 61 billion units, so that roughly translates at the rate of 4 paise per unit into 240 crore rupees. Now, if I say that all the three exchanges are equipoised to garner the market share, that again would become a sizable chunk, let us say around 80 crore or so. So that would be based on what the market size currently is. And secondly, currently HPX was able to contribute only 10 crore rupees to me total profit. So this would be a huge jump for the PTC consolidated financials. But that remains to be seen as to how much market share this HPX is able to gain. Second thing I would like to highlight that still, although we are trading around 240 billion units or so in all segments put together in short-term markets, but there is a potential to grow the trade and the market itself in the exchanges. So I think a major growth has to come from that. And I think all the three exchanges can survive.
Understood that, sir. Mr. Jawahar, so you actually mentioned that out of the 240 crore, you did a quick division by 3 coming to the 80 crore. At this point of time, you've not really accounted for any transaction cost reduction. That is number one. We take your point on board saying that volumes have been growing on the short-term market itself. So we do see that particular probability play out. But realistically, within the first couple of years, do you actually see an 8x jump in the contribution as far as revenues are concerned from HPX?
A lot of work is required to be done. I mean, being able to transact is one thing, but reaching out to the customers and making them understand the benefits of this HPX platform is a task. Of course, we have been in touch and we have pan-India relationships with almost all the utilities and all the generators. So I think it's a reasonable assumption that we'll be able to get a significant market share.
Sir, a couple of quick questions. In terms of operations, suppose there are a buyer and a seller. A buyer at IX, will he be able to sell the same product or the same units on another platform? Is that essentially what market coupling is? And number two, the CRC circular also talks about coupling coming about as far as the RTM market is concerned. So what is the kind of opportunity that you see over there?
You see, the second question first. Currently, this DAM segment is around 61 billion units, and the RTM segment, if I remember correctly, would be around 35 billion units. So that is also an important market, and that can also happen in due course of time whenever coupling is allowed on that. There is a roadmap, and I need to see how things evolve. So that is the second thing. What was your first question?
What kind of volumes are you expecting, Mr. Jawar, in the first year, as soon as this happens for you?
I mean, it would be reasonable for me to believe that if everyone is competing for the same space and if his services are kind of competitive, then this market would be equipoised and might be divided equally. That would be my starting belief, but then we would like to differentiate ourselves by better connect with customers and better services.
So what market share are you targeting? Ideal scenario would be one-third, one-third, one-third. But what is it that you're targeting realistically?
I would not call that ideal scenario, but I would call it a reasonable scenario. Ideally, I would like to gather as much as possible.
But no, realistically speaking, what kind of volumes do you think you can get? Or what kind of share do you think you can get initially as things ramp up?
You see, I'm reasonably confident that this exchange, if it plays its cards right, it should be able to get at least one-third share.
By when? By when?
Let us say 1.5 years, maximum 2 years.
Okay, all right, Mr. Jawar, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's PTC India talking to us. They do own 22% in HPX, and that's the reason they would benefit. And they are saying that it would definitely help them in terms of market coupling. But the market share and how much they gain Jan 2026 onwards will be something that they'll need to see, which will eventually go into the consolidated profits of PTC India. As you can see, the stock is up around 4.6%. We'll take a break now, but a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interaction with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty continues to see a decline of 0.5% in the trading session. But let's shift focus and talk about some of the earnings that have been reported. We have Supreme Petrochem, which is the next management that is joining in with us. And they reported a weak set of numbers this time. We saw a slip in terms of profit of 34% on a year-on-year basis. We have the ED at Supreme Petrochem, Mr. Rakesh Nair, joining in with us to talk to us about the numbers as well as the outlook of the company going forward. Mr. Nair, thank you so much for joining in with us. What we want to understand and what we want to start by talking about is in terms of the volumes of the company. What were the volumes this quarter? Was there any pricing pressure that you've seen during the quarter as well? And what are we watching out for now?
Good afternoon. We had almost the flat volumes as we had in the previous year. Only a marginal increase of 0.5% was there. But then the growth was not there. It was actually the domestic market was down for us because of the lower lifting by the OEMs. Because of the undue seasonal rains, all the cooling appliances sales were down, like refrigerators and air conditioners, and that's the reason. the lifting by the AC manufacturers was not there. Even in the non-OEM segment, the pickup was not great as compared to the previous years. So the growth was muted this year. As far as the pricing pressure is concerned, yes, the raw material prices, they fell down as I informed you earlier in my April interaction. From March to April, third week of April, there was a drop in prices of styrene monomer. And so that also reflected here in terms of our selling prices. So these were the two reasons mainly that the numbers were impacted.
Okay. Mr. Nair, welcome to the show. You met your guidance of around 3.5 lakh tons of volumes in FY25. What are you guiding for in FY26?
We hope to do almost around 12% more than the previous year, the total volumes. This current was the last quarter gone by was the flat. This is generally a lean period. The second quarter is generally lean period. But we hope that with the crop being doing well and the rains are also good, so the liftings would improve from September onwards. They should do well, and we hope to do almost close to 12% volume growth this year.
All right, 12% volume growth. What about the ABS project, which commercializes in the second quarter? What kind of ramp-up revenue are you expecting in this year and contribution next year?
This will be the first year of our entry into ABS, and already the startup activities have started, and we hope to start the production towards maybe sometimes in August it will happen. The collaborators team is also around here, and the process is on now. So we would be first testing the material at all the processors end also. So I think this year we would be only utilizing at the installed capacity 70,000. Maybe we would be for a 6 months period, it will be 35, and we would be doing something around say 50 to 60% of that this year.
That equate in terms of revenue at optimal utilization?
See, on a full capacity basis, full utilization basis, the asset turnover ratio works out almost 2. And for the current year's turnover of around 17,000 or so, this will add to maybe around 250 crores or so to the turnover.
Right. So, also just want to understand in terms of your value-added segment, how much does that contribute to the company? Because I believe in FY25, you had highlighted that, the volume growth overall in FY25 was around 8 to 10% that you were expecting. And that time you had mentioned the value-added product contributed around 35 to 40%. Is there an increase there, or could we expect this number going higher in FY26?
Yes, now when the ABS production starts, the value-added products will grow. But in the current quarter also, our value-added products were around 36% only.
Okay. Mr. Nair, you fleetingly mentioned your raw material styrene monomer prices, which have been largely stable in Q1. Tell us about what Q2 was in terms of pricing, or is in terms of pricing, and what is the guidance that you have when it comes to this raw material?
See, the styrene prices in the FY25 were generally closer to $1,100 during this period in the first half of the year. And then they started going down, and the drop came in from the mid-March to April end or so, the drop came by. And after that, the styrene prices have been holding on to around $950, $940. It is holding on right now. And we expect that if nothing else changes in the global scenario, this will continue.
So when you say nothing else changes in the global scenario, tell us what you're expecting, or what is that risk that you're envisaging?
The crude prices, the trade flows, the China and US, the trade agreements, all those issues are still hanging open in the global economies right now.
Has that had a bearing? Has that had a bearing on your exports business? What is your current proportion right now?
We did good exports in the last quarter, and we hope to continue doing good exports in this quarter also. But going forward, if the kind of trade flows, if the China stops buying, China's exports go down, so naturally the trade flows changes. The other markets where we are exporting, maybe the other competition will also come in there. So it's difficult to say at the moment.
Can you be a little more specific? What proportion comes in from exports and what are you expecting that to grow at?
See, our last year's revenue around 10-11% was from exports, and we expect that the same number would be there this year as well.
Okay, so 10-11% is what you're expecting from the exports going forward as well. So that will be something that we'll be watching out for. And margins over there, what is the margins that you get on exports? Is there something different, better margins there?
No. Currently, the margins there are lower than the domestic margins.
Okay. Just quickly on your guidance, which you are, envisaging in terms of volumes, I'm assuming you're going towards that 4 lakh ton mark for FY26.
That's right.
Again, what would probably be the key risk factor to this particular guidance? Would it just be the global scenario?
As of now, yes, only the global scenario.
Okay. All right. All right, Mr. Nair, we're going to leave it on that note. Thanks very much for joining in and speaking with us. That's Supreme Petrochem talking about their numbers, guiding for around 4 lakh tons in terms of volumes for FY26, or just about those levels. Well, we need to wrap up on the show, but the news that the markets are weak at this point, so there's no further deceleration which has taken place, but the mid-cap index is underperforming, down around 0.6%. The Nifty actually has caught up with a cut of around 150 odd points, so 25,071 is where the Nifty is holding at this point in time. We'll wrap up on Halftime Report. Business Lunch up next.